Okay, students, sorry about the end of that last video. I looked up there and all of a sudden saw I was running out of time, and somehow that flustered me a little bit, and so it kind of threw me off my game a little bit. But let's just go back and repeat what I was talking about. So we borrowed $100,000 at 6% interest. Let's find it right here. On October 31st. And so at year end, we had accrued 2 months worth of interest. So that would be $100,000 times 6% times 2/12. So that would be $1,000. So we're going to debit interest expense and credit interest payable to recognize the increase in the liability with the credit and the increase in an expense which decreases stockholders' equity with the debit. And there's our entry. Now, at October 31, the next year, we pay off the loan and the interest. And they kind of throw me off a little bit with the way they do things. But it's just the actual entries involved. Normally, what we would do in upper level accounting classes is just calculate the whole thing, because what do? They just pay $106,000, which is the total amount due, principal and interest. Now, this breaks it down and shows the interest separately. And so what I was doing last time was the easier way to do this, and the way a lot of financial books do it, is to go ahead and record a payable for the interest. So you accrue the other 10 months worth of interest up through October 31 when you're paying it off. And so that would be a debit to interest expense. And then we could credit interest payable for that $5,000. And then when we pay it, we would just debit interest payable credit cash for the $6,000. Now, they don't do that here that way. They just eliminate accruing the interest into interest payable and say we paid $6,000 interest off. So we have to remove that $1,000 interest payable that we recorded at December 31 in this entry. So we paid that off. So we debit interest payable to remove this for $1,000, and then we debit interest expense for the $5,000. Credit cash for $6,000. Now again, another way to do that would be to record the $5,000 with a debit to interest expense, credit interest payable, and then interest payable has a credit balance of $6,000. Debit interest payable for the $6,000, credit cash for the $6,000. Hope I'm not confusing y'all with that, but it's just kind of an easier way to see it. A lot of students, when they get ready to record this entry, I see them all the time: debit interest expense for $6,000, credit cash for $6,000, forgetting that we had accrued $1,000 of the interest up here at December 31. And I lose my cursor. I don't get the little yellow circle that you get. So anyway, to avoid forgetting to record that, I think the easier way is just to go ahead and accrue that interest on October 31, debit interest expense for $5,000, credit interest payable for $5,000. Now, if I had a T account here, we would show interest payable had $1,000 balance carried over from the previous year. We added $5,000, so we got $6,000 balance in interest payable, and we just debit interest payable for $6,000, credit cash for $6,000. Now again, I hope I'm not confusing you with that, but you see here the $1,000 is what we accrued at the end of last year. The $5,000 is the interest we accrued for this year. It's going to interest expense. Okay, then we pay off the loan. So that's $100,000 principal. We had recorded that in notes payable, somewhere up here, right here. So with a credit to notes payable, so now we're going to debit notes payable to close it and credit cash for the amount of cash paid to pay off the note right here. So right there. So debit notes payable to close out the liability, to reduce the liability, credit cash to reduce the cash for the amount paid. Okay, additional current liabilities, sales tax payable. Now, up till now, we've kind of been ignoring sales tax, but the reality is, if you go to the store and you buy something for $100, you take it up, they ring it up, and they don't ask you to pay them $100. Instead, they ask you to pay them $100 plus sales tax. So on a $100 item, sales tax would be around $8.25. $8.25 because sales tax rate in Wichita County, I think, is 8.25%. So you get up there and you pay $108.25. Now, in their example, the sales tax is $50 on a $1,000 purchase, or 5%. That's pretty low sales tax rate these days, but anyway, so you get up there and they ring it up, and they ring up a sale for the amount of the sale that they're making to you for the item you purchased. So my example, where you're buying something that cost you $100, they would credit sales revenue for $100. They would debit cash for the amount you're paying, which is $108.25. And then the other $8.25 they owe to the state of Texas. So they would credit sales tax payable for that. Now, the example they're giving here, they buy something for $1,000. Someone does. And so we sell it to them. We're having to pay, or they're having to pay 5% sales tax. So the amount of the sale is $1,000. So we credit sales revenue for $1,000. The amount of tax payable is $50, 5% of $1,000. And the amount of cash we collect is $1,050. So that's our journal entry. Debit cash for $1,050, credit sales revenue for $1,000, and credit sales tax payable for the $50 sales tax that we collect for the state of Texas. Okay, so let's do a homework problem. So we go up here to mini exercise 10.2. Grandpa Clocks Inc. GCI is a retailer of wall, mantle, and grandfather clocks. Assume GCI sells a grandfather clock for $10,000 cash plus 4% sales tax. Clock had originally cost GCI $6,000. Show the accounting equation effects and prepare the journal entries related to this transaction. Assume GCI uses a perpetual inventory system as explained in Chapter 6. Well, you remember, I hope, that with a perpetual inventory system, right here, we're going to have two entries. One to record the sale, the other to record cost of goods sold and reduction of inventory. So they sold a clock for $10,000. So we're going to credit sales revenue for $10,000. They had to add on to that 4% sales tax. So 4% of $10,000 would be $400. And so they would credit sales tax payable for $400 and then debit cash for the $10,400. That records the sales portion of the transaction. Now we have to deal, there we go, debit cash for $10,400, credit sales tax payable for $400, credit sales revenue for $400. Now we have to go back and deal with the cost of goods sold and reduction of inventory part of the transaction. So the clock had cost us, or cost GCI, $6,000. So they need to reduce inventory by $6,000 and record that as cost of goods sold. So debit cost of goods sold for 4,000 or 6,000, credit inventory for 6,000. Okay, I hope you understand that. Now, I think that one will be the next homework problem we go to. Let's move on. Deferred revenue. Remember, deferred revenue is a liability. That's when customers pay you in advance of you providing the service or goods to them. Common examples where deferred revenue comes into play would be where you sell gift certificates or gift cards. You debit cash, credit deferred revenue, because you have collected cash, but you have not provided the customer goods or services yet. Another example would be where a sports team, let's say the Texas Rangers, sell you a season ticket. If we have baseball this summer, hope we do, but who knows? If we do, they may be playing to empty stadiums. But anyway, let's say they sell you a season ticket for $2,000. Well, they haven't played any games yet. So what do? They debit cash for $2,000, credit deferred revenue because they have an obligation to you to provide you with games in the future. So that's part of the definition of a liability, right? So they have an obligation to you to provide games. They arises from a past event or transaction. You paid them money, and there is a future obligation. They're obligated to provide you with those games or to refund your money. Okay, so there we go, debit, cash, credit, deferred revenue. Now, as, let's say, $2,000 for games for the Texas Rangers, and let's just say, I know baseball season is 164 games and 82 home games, or no, 162 games, I'm sorry, and 81 home games. Let's just say 80 home games. And 80 into 2,000 would be $25 a game, I believe. So when they play a game, what should they do? Well, they have reduced that deferred revenue by $25 and earned revenue of $25. So in our case, our example, they would debit deferred revenue for $25, credit revenue for the $25. Now here they are collecting $8 million for advanced ticket sales for 2 concerts. They provide the first concert, and so they've earned half of that, $4 million. So they debit deferred revenue for the $4 million, reducing the liability, and credit service revenue, increasing stockholders' equity for the $4 million. Okay. Current portion of long-term debt. Now, if you have long-term debt, let's say you're buying a car and you sign a 6-year note, then if you're recording that in your books, you're providing financial statements, you may want to say, well, I've got this debt. Let's say you buy the car for $35,000, or let's say $36,000, and you want to record $36,000 of long-term debt. Well, the reality is you're making payments every month, so a portion of that $36,000 is coming due in the current year. Okay, my 15 minutes on this video is just about up, so I'm going to go ahead and stop, and we'll pick up there on the next video.